Dividend investors are naturally drawn to high yields as these promise attractive returns. However, a high yield often comes with higher risk, demanding a careful evaluation of trade-offs. This analysis compares AGNC Investment Corp. and Federal Realty Investment Trust NYSE, FRT, two REITs that cater to income-seeking investors but follow vastly different strategies. AGNC Investment, the yield leader. AGNC Investment boasts an impressive dividend yield of over 15%, far surpassing the 3.9% offered by Federal Realty. To put this into perspective, AGNC yield is more than 10 times the S&P 500 average of 1.2%. It outpaces the 3.7% average yield of REITs, as measured by the Vanguard Real Estate Index ETF. While such a high yield is undeniably appealing, it's essential to recognize the associated risks. Federal Realty, the stability champion. While Federal Realty's 3.9% yield may seem modest compared to AGNC's, it carries a different kind of appeal: reliability. Federal Realty is a dividend king, having increased its dividend for 57 consecutive years, the longest streak among publicly traded REITs. This consistency underscores Federal Realty's ability to generate steady income regardless of market conditions. In contrast, AGNC's dividend history tells a less reassuring story. The company has reduced its dividend multiple times since 2016, with its current payout of 12 cents per share per month stagnant since April 2020. Understanding the REITs, business models matter. The divergence between AGNC and Federal Realty extends beyond yield and stability to their underlying business models. Federal Realty operates as a traditional landlord, owning and leasing out high-quality strip malls and mixed-use developments. With a portfolio of around 100 properties in prime locations, its revenue stream is straightforward and predictable. 2. AGNC Investment, on the other hand, is a mortgage REIT. It invests in mortgage-backed securities, earning profits from the spread between interest income and operating costs. This approach is more complex and inherently riskier, relying on external factors like interest rates and market conditions. Key takeaway: balancing yield and stability. While AGNC Investment delivers a jaw-dropping yield, its history of dividend cuts highlights the risks involved. Investors seeking long-term, reliable income may find Federal Realty's track record and stable business model more appealing. In essence, AGNC is suitable for those prioritizing total returns over consistent dividends. Federal Realty is ideal for investors seeking reliable and growing income streams. Final thought: choosing the right REIT for your goals. Both AGNC and Federal Realty have their merits, but your choice should align with your investment objectives. If you're drawn to AGNC's high yield, ensure you're prepared for potential volatility. On the other hand, Federal Realty offers the reassurance of dividend consistency, albeit at a lower yield. Ultimately, dividend investing isn't just about chasing the highest yield. It's about finding the right balance between yield, stability, and risk.